Hello everyone. Thank you very much for attending. Welcome to this P&I webinar. I am Shahryar Safai. I'm a research director at EDHEC-Risk Institute, a leading academic center for research on investment management founded in 2001. With me on the line is Lionel Martellini. Hello, Lionel.
Hello.
He's a professor of finance at EDHEC Business School and also the director of EDHEC-Risk Institute. We will both be speaking today. We expect our presentation to last around 45 minutes. We'll then open for Q&A, so please feel free to submit your questions throughout the presentation so we can address them at the end of the session. I will now start with a brief overview of today's content, and we'll then pass it on to Lionel to kick things off. So our goal today is to introduce you to a new fixed income asset called the retirement bond, and hopefully convince you that it can help solve some of the challenges of decumulation investing. In the first section of the presentation, we'll provide some context on the decumulation investing problem, also known as the retirement income problem. It turns out to be both an important and complex problem, and it will likely continue keeping academia and the financial industry busy for some time. Now, although no definitive solution has emerged yet, it is commonly agreed that the first step towards a solution is the introduction of a risk-free asset with respect to retirement income. The insurance industry and the asset management industry have both already attempted to offer this first piece of the puzzle. And our second section will explain why existing offerings are nevertheless coming short. Then in the third section, we will introduce the retirement bond itself and show why it is a genuinely risk-free asset for the first 20 years of decumulation, and why it alleviates some of the concerns raised in the second section. And finally, in the fourth section, we will show some promising results on the investable nature of the retirement bond, and will present two practical benefits that retirees may derive from the retirement bond: the ability to efficiently take risk to grow retirement income, and also the ability to reduce retirement income risk without giving away any upside. And with that said, Lionel, over to you.
Thank you, Shahryar. Hello, everyone, and welcome on board for what I hope will be an exciting journey through the fascinating landscape of decumulation investing. Maybe first, let me start with a word of caution. This journey is not for the faint-hearted. Let's actually start with a quote from Bob Merton, who's a Nobel Prize-winning economist, who's of course well known for his work on option pricing theory, but has done tremendous amount of important work on retirement investing. And here is the wake-up call, very important wake-up call to pay attention to. That wake-up call was voiced in 2014, so a few years ago. Here is what Bob says: our approach to saving is all wrong. We need to think about monthly income, not net wealth. The only way to avoid a catastrophe is for plan participants, professionals, and regulators to shift the mindset and metrics from asset value to income. Okay, so let's try and get a little bit of perspective, and let's try and understand why is it that we collectively got misguided and lost on the heavy focus on wealth, while income is actually what matters. Well, this is a good opportunity for me to propose a formal discussion of the decumulation problem and how it differs from the accumulation problem. Let me put it this way: most of the focus in the investment industry has historically been on accumulation, and the accumulation problem is all about efficiently turning income, which is saving along the way through accumulation, into wealth. And the main goal is to grow wealth. Now, in contrast, the decumulation problem is actually defined as the opposite problem, which is the challenge of efficiently turning wealth back into income as we reach decumulation, as we reach retirement, and then we need to generate replacement income. Now, from a formal standpoint, a decumulation investing strategy can be regarded as a pair of two important sets of decisions. One is WT, which is a portfolio decision, a portfolio investment decision. So we need to decide how much to allocate to different assets at different points in time. This is known as the investment strategy, but then we also need to worry about the income strategy. And the income strategy is how much money do we want to withdraw from our account at every point in time. Now, if you look at the academic framing of this problem, and on the left-hand side, you look at the accumulation problem, well, it's all about maximizing expected utility of terminal wealth. And by terminal wealth, we mean wealth at retirement date. And the control variable, the decision that we need to make are solely related to these investment decisions. Now, if you switch to the right-hand side, if you switch to the decumulation problem, then the decumulation problem starts at date capital T, which is retirement date, and presumably ends at date tau, which is this random uncertain date of death. And there, we need to optimize over expected utility of intertemporal consumption, the consumption that we derive from, this income that we get from the retirement account, in addition to whatever additional sources of income that we can depend upon in retirement. As we can see, the problem is much more complex if only because now we have to worry about two sets of decisions. Well, it's actually not a simple problem. So let me show you here two quotes from two other prominent financial economists, both of them being Nobel Prize-winning economists. Well, the first one is from Richard Thaler. Decumulation is a more difficult challenge than accumulation. Okay, yes, that's kind of a comforting view of the fact that it's going to be more complex, if only because we've got to come up with two sets of decisions. Now, Bill Sharp, the founder of the capital asset pricing model, says it in an even harsher and more direct way. Decumulation, I love the quote, decumulation is the nastiest, hardest problem in finance. So this is really something that we need to very seriously worry about, and this is something for which we need to dedicate quite a bit of attention. And the fact that it is a hard problem arguably explains why, in part, why it hasn't received the kind of attention that accumulation problem has received. This is probably not the explanation, but we've got to come to peace with the fact that the problem is a bit more challenging. Now, the bad news is that we're kind of stuck in a dead end at the time being. On the one hand, if you look at the academic insights about optimal investment consumption or optimal investment income decisions, let's call them W star and I star T, which are optimal decisions that we could make in terms of how to allocate assets and how much to withdraw from our account at every point in time. Well, there has been a large body of work on these very questions, starting with seminal work from Bob Merton again. But this work typically leads to non-actionable prescriptions. And by this, I mean that the decision about how much to withdraw from your account is actually a function of non-observable variables, including something like the Sharpe ratio on risky assets, which is something which is extremely noisy and very hard to estimate with any degree of accuracy. So there's no very practical, implementable prescriptions that come out of these models, at least as far as the income withdrawal decision is concerned. Well, in this context, the industry and investment professionals and wealth managers have explored a landscape of different withdrawal strategies, and perhaps the best known strategy is the so-called 4% rule that suggests that the income withdrawal should be equal to 4% of initial wealth, and that should take place regardless of personal circumstances and market conditions. But that, of course, is kind of heuristic shortcut way of thinking about income decision is not satisfactory. It's certainly not optimal from any academic standpoint, but worse than this, it's actually not compelling from an intuitive standpoint. And if you think about some intuitively desirable properties for income withdrawal, and I'm just listing here a list of 3 different properties: feasibility, exhaustivity, and moderation. And tonight and today, we're not going to bore you with all the mathematical details on how these 3 axioms, if you will, or properties can be formally defined. But essentially, these are very intuitive ways of thinking about, the fact that you don't want to withdraw more than what you own. You don't want to underspend, but at the same time, you don't want to spend too much too early at the cost of being left in a difficult situation later on. Well, if you think about these 3 conditions, it actually can be shown that the 4% rules violates all 3 axioms. It doesn't satisfy these desirable properties. Okay? So the construction of joint investment income strategies that work well from a practical standpoint, that are implementable, that work well together and for individuals is a really important and interesting question. And by the way, here at EDHEC-Risk Institute, it's the focus of an ongoing research partnership with Bank of America, which has gone on for the last 10 years or so. And this is the very focus of what we're trying to accomplish now in that space because of the importance of the problem. Okay, so it's a difficult situation. We're stuck in a dead end. Academic insights do not lead to actionable prescriptions, and practical prescriptions are a bit not satisfactory. Let's still take a look at some good news, and let's not only focus on the bad news. So here is the good news. Remember the first quote from Bob Merton. He said, the only way to avoid a catastrophe is for everyone to shift the mindset from asset value to income. And that's, regardless of the delicacies and technicalities of how we solve the decumulation investing problem or how we approach it, this shift of mindset is the critical component. Here is the good news. This awareness is starting to happen as we speak. We have good reasons to believe that the different stakeholders in this particular problem are currently massively shifting in terms of massively understanding the importance of recognizing the relevance of the focus on income. This is just a survey that shows that from a plan participant perspective, this University of Michigan survey shows that, satisfaction of participants actually increases as a function of the level of income that they can expect to withdraw from their account. So from the plan participant's perspective, it is actually very clear that this mindset, this focus on income is actually very important. Now, from the professional or the employer's perspective or the plan sponsor perspective, we are now getting at a stage where this is heavily recognized as well. So this is another survey from Aon on driving DC plan success. And what we find in this survey is that almost 75% of employers believe that plans should include lifetime income options, which is in contrast with the striking finding that less than 10% of them actually offer these lifetime income options. So it sounds like we are this very interesting turning point where, we are not there yet, but we have a broad understanding that this is the way to go. Now, very interestingly, from the regulator perspective, this increased focus on income has also taken place. And in particular, in the US, with the Secure Act, there's a clear emphasis on providing more incentives for plan sponsors to, be able to offer income solutions to plan participants. And there's a different set of prescriptions within the Secure Act for how plan managers will be able to offer these guaranteed products, including in the form of annuities. And this is an interesting development that only emphasizes the fact that we are now at the turning point where all the stakeholders around the table seem to recognize the importance of this shift in mindset from asset to income. Okay, so one way of thinking about it is something that we could call a DBization of DC plans, so this growing awareness in DC plans of the need for retirement income security. So that's the good news. Now, clearly, achieving retirement income security requires using a dedicated risk-free asset, meaning a risk-free asset, an asset which is risk-free with respect to retirement income. I mean, this statement is almost tautological. Well, here is the question. Given that the Secure Act is lifting the burden of fiduciary responsibilities from plan sponsors to offer these income guaranteed, products, here is the question. Is the introduction of annuities, which after all are the ultimate risk-free assets in decumulation, are these annuities, which we could use as qualified default investment alternative in DC plans, is this the solution to the decumulation problem? Is this the road that we should collectively be taking? So this is the question that I would like to discuss next. So we're now turning to these outstanding puzzles in retirement investing, and the first puzzle is the well-known annuity puzzle. And here is what the annuity puzzle tells us. And if you allow me to quote another Nobel Prize winning economist, so I think now we are at the count of 4 so far. So, Franco Modigliani, in his Nobel Prize acceptance speech, tells us, well, it is a well-known fact that annuity contracts, other than in the form of group insurance, group pension systems, are extremely rare. Why this should be so is a subject of considerable interest that is still ill understood. So let me bring this empirical evidence. So I'm just looking here at a couple of academic papers. A first paper by Stacy Schaus, published in 2005 in Journal of Pension Benefits. And this is what we find: only between 2% and 6% of participants in large 401k plans elected an annuity when the annuity was available. And by the way, there were very few plans in which the annuity was available in the first place, as we discussed before. Now, a convergent perspective from more recent analysis from Lockwood 2018 in AER, American Economic Review, in the US, only about 5% of retirees buy life annuities to convert their wealth into a lifelong income stream. So here is the thing: even though in principle annuities are the proper choice and a very natural choice as a risk-free asset for decumulation, it seems to be the case that it's not going to happen in practice to think about annuities as the solution to the dead end, to the dilemma that we are facing, if only because there seems to be a high degree of reluctance from investors and individuals to buy these annuities. Now, there actually are many explanations to the so-called annuity puzzle, the fact that investors do not want to buy these annuities while they are very useful. In principle, I mean, the standard annuitization to the annuity puzzle are, pre-annuitized wealth already exists through Social Security and private pension plans. Another reason is the complexity and inflexibility of contracts. Another key important reason is the fact that there's a strong bequest motive for most people, that you kind of give up on bequest as you buy annuities. And there are a bunch of additional explanations, some related, of course, to the presence of counterparty risk. When you buy annuities from an insurance company, there's issues about price transparencies, and there's a lot of behavioral bias that come into play. But the bottom line is, well, this is just something that people are reluctant to be doing. And even if we may see an increase in the acceptance or the demand for annuity, it is very unlikely for all these reasons that annuities are going to become the natural default option as a risk-free asset in decumulation. Okay, so what is it that most individuals do if they do not, buy these annuities? Well, in their retirement pot, most individuals would rather use investment products such as these target date funds. And the reason is that they have all the flexibility in the world, and that, that there's no issues about bequest and so on with all these investment products. But this in turn raises yet another interesting puzzle. This other puzzle is known as the duration puzzle. It's slightly less known than the annuity puzzle, so let me try and explain what the duration puzzle is all about. So the word duration puzzle was coined in a recent paper published by these three co-authors in the Review of Finance in 2020. And here is what these papers explains. It explains that when you look at the fixed income component of target date funds, well, the duration of the fixed income component happens to be pretty stable over time at a value which is on average around 6 years. And if you look at the 10th and the 90th quintile, it kind of varies anywhere between 4 years to 7 years. And the reason why that's a puzzle, well, the authors explain it very clearly. Well, the average duration of these fixed income portfolios is flat over the life cycle and is low relative to the investor horizon. This is a pattern that seems to be at odds with classical portfolio theory. And as we know from the seminal work from Campbell and Vishera, for example, long bonds with a low duration are not desirable from the perspective of a long-term investor. They're actually risky assets, as we will confirm in a few moments. In addition to being risky and to expose long-term investors to interest rate risk, these short-term bonds on average offer a lower yield compared to long-term bonds. So it sounds like it's a lose-lose proposal. So now, as much as we have good explanations for the annuity puzzle, and we understand why people are actually reluctant from using annuities, even though on paper it is the perfect risk-free asset in decumulation, we don't have any good explanation for the duration puzzle. There's just no good explanation why we should be holding fixed income portfolios that just do not do the job that we need them to do when we turn to decumulation. There's no good explanation. And when there's no good explanation to a puzzle, it probably suggests that something needs to be done. One way to think about it is we need to fix those fixed income portfolios, right? We need to do something about them so that they actually become more suitable to the needs of individuals in decumulation. Okay, so this is what we're going to turn to now, and I'm going to introduce the retirement bond, and I'm going to try and argue that the retirement bond is an easy fix to the duration puzzle. Okay, so what is the retirement bond? The retirement bond is some kind of a fixed income security that pays constant or cost of living adjusted cash flows for the first 20 years in retirement. Okay, so if you compare in this picture the cash flows of the retirement bond in orange and to the cash flows of the straight bond in blue, you see there's a big difference, right? So for a straight bond, so both of them at the date 2021, which is today, both of them start with a outflows where you're going to pay some amount to buy these bonds. Now, with a straight bond, you start to receive coupon payments on a semi-annual basis or an annual basis, as early as in accumulation when you don't need those coupon payments. And then eventually, in this case, 15 years later, you get a big payment back, which is the principal back in 2035. Well, these set of cash flows doesn't look like the kind of cash flows that people need to generate replacement income in retirement. What people need is, well, they need nothing. No cash flow are needed in accumulation. And when they enter the accumulation, well, then is the time when you need these cash flows, these replacement income cash flows to start taking place. And in this case, they take place for 20 years in retirement. So it is in this case, that in this sense, that the retirement bond is the true risk-free asset for the first 2 decades of retirement, because the retirement bond actually pays fixed income, while fixed income portfolios within target date funds actually do not pay fixed income. And that's a bit ironic, given that they are based on fixed income securities. So the beauty of fixed income securities is to pay fixed payments. So while we use these straight bonds and repackage them in such a way that eventually we get a portfolio that will eventually pay the kind of fixed income payments that we need, fixed or again cost of living adjusted cash flow payments that we need in retirement. Okay, is there anything comparable to the retirement bond, or is this something entirely new? Well, there's actually a concept which is highly related to the retirement bond, which is the selfies concept that has been popularized by Bob Merton again with his colleague Arun Muralidhar. And both Bob and Arun have been very vocal and very efficient at explaining how it would be useful for the world to get access to these standard of living index forward starting income only securities. Now, these selfies are essentially similar to the retirement bonds that we've just discussed, with a key difference, which is the cash flows for the selfies are indexed with respect to aggregate per capita consumption. And that is a very interesting feature because that feature allows, on the one hand, individual to hedge standard of living risk, so that's even better than cost of living adjustment or inflation linkage. So that's very good from the individual standpoint. It turns out that it is also very good, as explained by Bob and Arun in their work. It is also very useful useful from the perspective of the issuer. If you think about some government or national, supranational agency that issue those bonds to, say, finance infrastructure projects, well, then there's a natural linkage through the linkage to aggregate per capita consumption, which would, as it increases, generate more revenues for the state. In other words, these selfies would solve not only the asset liability management problem for individuals, but also the asset liability management problem for the issuer themselves. So it's like a win-win concept. Now, this is not an investable concept. In other words, the introduction of selfies, if and when it happens, would actually generate strong welfare improvement via market completion. They would complete the markets. And actually, with Bob and Arun, we've tried in Europe to also talk to different governments and agencies, and including here back in France, where EDHEC-Risk is located, and trying to convince them that, making the case for these selfies. And one of the answers that we got from the person in charge of the French agency issuing, and managing the sovereign debt of the country is, well, we don't think that this is our duty to launch those bonds, even though we recognize that could be useful for investors. But, if you abstract away from this indexation with respect to aggregate per capita consumption, then, these retirement bonds, you should be able to replicate them with the existing stock of sovereign bonds. So here is the big difference. Retirement bonds are redundant securities. They can be replicated with the existing stock of sovereign bonds. And then we'll turn to Shahir discussion a bit later on, who will explain, how these can happen and actually indeed demonstrate the feasibility of replicating retirement bonds with existing debt. Okay. Now, one of the key benefits of the risk-free asset in decumulation is that it facilitates retirement income planning. So what we mean by this is that the retirement bond can be used, first of all, as a device. And that device allows us to turn wealth into income and then conversely turn income into wealth. So let's take an example of someone who needs a desired additional replacement income level of $30,000 per year. Now, how much wealth do they need to possess to generate this kind of income? Well, in this case, based on the retirement bond price as of October 22, 2021, that wealth turned out to be around $500,000. So the price of the retirement bond, so if you take your wealth and you divide it by the price of the retirement bond, that allows you to obtain the income level that you can achieve. And that's, of course, the reverse side of the equation. So the retirement bond price is a very convenient tool to turn income into wealth and wealth into income. Now, if you look at the affordable income that you can purchase with the retirement bond, and in this case, we're assuming for somebody who has a normalized $100,000 worth of saving, well, that amount of annual income that you can secure for 20 years in retirement actually varies over time as a function of interest rates. And, something like 30 years ago in 81, you could actually secure as much as $14,000 worth of annual income with $100,000 worth of wealth and saving. By now, at the current time, that number is actually shifted to a value closer to $6,000 per year, reflecting, of course, the big drops, the continuing drops in interest rates. Okay, so that's a very useful tool to have because it allows us to translate wealth into income and income back into wealth. It also, of course, leads to retirement income security, and that's the main benefit of introducing a risk-free asset. So to see this, just let's assume again that somebody has $100,000 worth of saving at the start of retirement. And then let's call X dollars the annual affordable income level for the next 20 years. If we're asking the question today, that X number is $6,000. This is how much income you can secure for the next 20 years if you buy $100,000 worth of retirement bond today. Now, the next question is, let's suppose that you invest your wealth, your $100,000 wealth, in your preferred fixed income portfolio, whatever it is, and spend exactly X dollars, so $6,000 every year. And then the question is, what's going to be your final cash balance after 20 years? And the key concern is, well, are you going to be able to spend your affordable income, or are you going to run to a place where you're going to run out of money too early? To see this, we have implementing the strategy historically and have observed the outcome out of many different 20-year scenarios over the past history. And here is what we find. This is the distribution of the final cash balance. What we find is there's a lot of risk, there's a lot of uncertainty. If your fixed income investment is either cash or U.S. aggregate index, which is a good proxy for the kind of fixed income portfolio that you find in the target date fund. You could also look at U.S. intermediate treasury index, which is instead a good proxy for, let's call it a stable value fund that you find in 401k plans as a guaranteed kind of income option as well. Now, if you pick and choose these three possible choices of a fixed income portfolio, which are widely perceived as pretty safe, what you find is actually a lot of risk. You find a big dispersion of the cash balance. And the bad news is most of that uncertainty is on the downside. You're going to be running out of cash, right? You're going to end up with a negative balance, meaning that you're not going to be able to make those $6,000 payment or whatever they are at the start of the period for the next 20 years. Of course, this is in contrast with the retirement bond, because with the retirement bond, by construction, there's no retirement income risk. You know that after 20 years, you will be able to generate this $6,000 withdrawal, and there's no uncertainty, no risk involved in that process. Now, a risk-free asset is not only extremely useful when it comes to the investment side of the equation, but it is also useful when it comes to the income side of the equation. So if you remember that a decumulation investing strategy is the complex combination of investment decisions and income withdrawal decisions, well, you could actually use the retirement bond as a way to define a new withdrawal strategy. We have a name for it. We call it the maximally moderate income strategy. And we would need more time to explain why we gave that name, but essentially it's a strategy that recommends that on every single date you spend or you withdraw from your account the current purchasing power, which is given by your current wealth divided by the current price of the retirement bond, which is denoted by beta T in this slide. And this maximally moderate income strategy has a lot of very strong, intuitively appealing properties, including that it satisfies the three axioms that I was referring to before, which were violated by the 4% rule. So it's an alternative to the 4% rule. And if we get an attractive alternative to the 4% rule, well, from an academic standpoint, it's kind of exciting because then we can start thinking about, if I want to do maximizing expected utility of income, subject to the fact that this income is now set to be equal to the purchasing power of my current wealth level at every single point in time and in every scenario, then I can try and back out what would be the optimal investment strategy that would be optimal given this not necessarily optimal, but extremely meaningful and intuitively attractive income withdrawal strategy. And you can frame the problem in an expected utility maximization type of academic framework, or you could also think about a goal probability maximization perspective. And goal-based investing has become, if you will, a very natural angle and approach to be thinking about the decumulation problem. On goal-based investing, let me just mention that in the context of another ongoing research partnership, this time with FirstRand, we are actually exploring the fascinating landscape of decumulation investing strategies, and we make a key distinction between goal-based investing strategies that actually are based on a safe asset like gold hedging portfolio, like the retirement bond, and those that are non-goal-based investing in nature, in other words, that do not try and protect or cannot protect retirement income. And then there's a lot of subtleties between these goal-based investing strategies, and there are different types of them, and some of them are more aggregated in the perspective of implementing goal-based investing, and some of them are more isolated, also known as lockbox. And the lockbox approach is something that has also been explored by William Sharp, but hopefully all of this fascinating discussion will be the focus of a next seminar. So before I take too much time, let me now hand over the discussion to Shaya for more analysis of the benefits of the retirement bond. Shaya?
Thank you, Lionel. Let's now move to the final section of our presentation and look at the benefits of the retirement bond when used in decumulation strategies. So first, we need to find a way to actually purchase the retirement bond. And as mentioned earlier, it is a redundant asset in a sense, and it can be replicated with existing treasury securities. So for illustration purposes, we're going to present one example of a replication strategy in the next 3 slides. So we're considering a combination of a suitable selection method and a standard duration matching strategy here. So that's the illustration we're giving here, but more advanced hedging methods are available, and the paper referenced in the footnote covers a full spectrum of techniques for those of you who are interested. So our replication universe is comprised of nominal treasuries. This means that we avoid credit risk, and we have a fairly large and broad universe of securities to play with. Inflation-linked bonds may also be considered, but this would be at the cost of a higher replication error, given the size and breadth of the TIPS market in the US. An alternative approach would be a cost of living adjustment that would be baked into the retirement bond cash flows. We have also tested this approach for adjustments ranging between 2 and 4% per annum, and we didn't observe any material impact on replication error compared to the no adjustment case. So the first step of our replication strategy is a ladder type of selection, where we effectively pick bonds with durations spanning the maturities of the retirement bond cash flows. The second step is a duration-based allocation that tries not to deviate too much from equal weights, so to reduce the amount of rebalancing, so to promote stability. Let's now look at some results. So here we're replicating a 2011 retirement bond. What does that mean? That means it's a retirement bond that pays its very first cash flow in 2011 and pays its final and 20th cash flow in 2030. Both graphs on the slide compare the historical performances of, on the one hand, the investable replicating portfolio, that's the blue line, and versus the theoretical non-investable retirement bond, that would be the orange line on those graphs. The graph at the top goes from 2007 to 2021. So we start replicating in accumulation before retirement, effectively, while the graph at the bottom only starts in decumulation, literally a year before the very first cash flow is paid in 2010. The performance here is represented on a total return basis because that's simple to visualize, but we'll see in the next slide what this actually means in terms of cash flows. So two takeaways from this slide. The first one, a standard duration strategy is overall doing a decent job at replicating the retirement bond. And second, the quality, and you can see that on the graph, the quality of the replication seems higher in decumulation. So let's now look at those results again from a retirement income perspective. So what we mean by a retirement income perspective is that we care about delivering the right cash flow at the right time. And for that, we re-express the replication error as an average cash flow coverage ratio. So what this coverage ratio tells us is, what percentage of the targeted cash flow our replicating portfolio has managed to deliver throughout the period. And the answer is 96% when the replication starts in accumulation, so that would be in 2007 as a starting point, and 99% when it starts in decumulation. So note that these numbers are consistent with the visual takeaways that we had from the previous slide. So that means that you get on average the replicating portfolio delivers on average 99% in decumulation, 99% of the cash flows that the retirement bond was meant to deliver. So the question is, why is the quality of replication dropping in accumulation? And the answer is because the distant cash flows of the retirement bond, namely the cash flows, say number 18 and 19 and 20, so the ones at the tail end, they're just too far in the future to be appropriately spanned by the available stock of treasury bonds in the market. And that can be seen visually as well in the next two graphs that I just showed on the screen. The blue line here is the affordable income supported by the replicating portfolio at any point in time. So to be clear, if our replication was perfect, you would see a straight horizontal line, horizontal blue line, consistent with the constant cash flows delivered by the theoretical retirement bond. And so any volatility that you observe or any deviation that you see from the initial level is due to replication error. And we do see that the difference, we see the difference between starting in accumulation on the left-hand side and starting in decumulation on the right-hand side. So to conclude on the topic of replication, so our early results are definitely promising. It is possible to largely secure retirement income in decumulation with a dynamic portfolio of U.S. Treasuries. Of course, further improvements would have to be considered for a fully investable solution, and in particular paying attention to liquidity and turnover. So now we turn to the final topic of our presentation today, namely how is a retirement bond going to enhance decumulation strategies to improve the retirement prospects of investors. So for that, we set the stage again, just like we did in an earlier slide, when we were looking at a secure strategy. So we assume a certain level of wealth at the start of retirement. We compute our affordable income for the next 20 years. And we plan to spend exactly that amount while being this time invested in a balanced portfolio comprised of an equity sleeve and a fixed income sleeve. So the presence of equities now in the portfolio means that this strategy is not risk-free, obviously. And this time around, the questions are as follows. So how volatile is the final cash balance going to be? Obviously, we know it will be volatile because we're holding equities. So the question is how volatile? And the second question is, okay, so we're taking retirement risk here for sure, but is it well rewarded? And the third question is, there certainly is a risk that we run out of money too soon, but how often is that likely to happen? And we tested the strategy historically, and we're presenting some answers to these questions in the next 3 slides. So there are multiple ways to present the benefits of the retirement bond in decumulation strategies, but we thought we would use a format that will remind many of us of our days in university when attending a Finance 101 class. So if you remember, we were told back then that introducing a risk-free asset in the investment universe is a good thing because it improves the efficient frontier available to investors. Thankfully, this is still true, and it does apply to decumulation investing. The only nuance here is that we need to carefully redefine risk and return in relation to income rather than wealth, and therefore recognize that the risk-free asset is going to be different as well as a result. So the graph here is simply showing what we've known since our Finance 101 class. In a world without the retirement bond, where, say, the US aggregate portfolio is a standard bond portfolio, and the safe assets in your balanced portfolio, the opportunities available to investors are on the blue frontier. And we then introduced a retirement bond. That's our risk-free asset with respect to retirement income. And we let it replace the US aggregate in the balanced portfolio. And the result is an improvement of the frontier from blue to orange, basically shifting to the left and up, which indicates less risk and more return, or as in less retirement income risk and more retirement income return or growth. In other words, and just to summarize, the retirement bond improves risk-adjusted returns with respect to retirement income. Note that we have used balanced portfolios here for illustration purposes, but this could all be generalized to target date portfolios introducing glide paths. And so these efficiency gains that we're describing here, that they may sound conceptual at this stage, but they do have very powerful practical implications, which we will cover in the next 2 slides. At a high level, the implication is that retirees may use a retirement bond to spend their risk budgets more efficiently. Let's move to the next slide to see this in more detail. So if you remember, the second question we asked earlier was, are we getting well rewarded for the retirement income risk we're taking in the balanced portfolio? And obviously, the comprehensive answer to that question would require a view on equities as an asset class, and that's beyond our scope today. But all else being equal, using the retirement bond as a safe asset in the portfolio means our entire risk budget is more efficiently allocated to equities. And that's because the retirement bond is truly risk-free with respect to retirement income for the first 20 years, unlike other fixed income portfolios which we saw earlier. So put another way, when replacing a standard bond portfolio with the retirement bond as the fixed income asset, an investor can increase the equity allocation without increasing the risk. And that is because, in the presence of the retirement bond, we are effectively more efficiently spending our risk budget. And that's what the graph on the slide is showing. So the orange line is the equity allocation that one can add for the same level of retirement income risk by substituting the retirement bond for the US Ag portfolio. So for instance, this orange line shows that if you're at a 30% equity allocation, so a 30% equity, 70% US aggregate portfolio, that would bear the same level of retirement income risk as a 39% equity and 61% retirement bond allocation. So you have an extra 9% of equity allocation available without increasing retirement income risk. And of course, the benefit of that substitution decreases as the portfolio contains less and less fixed income, which is why the line is downward sloping as we approach the 100% point of equity allocation on the right-hand side. So now moving to the next slide for another practical benefit, again related to this concept of efficient spending of the risk budget. So this is actually really symmetrical to what we just said about the ability to increase the equity allocation with no extra risk. Indeed, some people may actually prefer to keep the equity allocation unchanged and simply enjoy the lower retirement income risk obtained by introducing the retirement bond. So to illustrate this point, and somehow to also answer the earlier question about the likelihood of running out of money too soon, we've shown on this graph the historical probability of ending with a negative cash balance after 20 years. So just remember, the strategy we're looking at assumes we maintain a balanced portfolio for 20 years. Every year we spend the affordable income that we had computed at the start of retirement. And the risk here is that we may or may not run out of money. That is, we end up with a negative final cash balance. So you can see on the graph that the orange line is always beneath the blue line, which means that regardless of the portfolio allocation, the historical probability of running out of money goes down when we substitute the retirement bond for a standard bond portfolio like the US Ag. So just to recap on the last two slides. So in practice, the efficiency gains brought by the retirement bond can benefit retirees in two possible ways, either by allowing an increase in the equity allocation while keeping the same level of retirement income risk, or by reducing retirement income risk while keeping the same equity allocation. And we have now reached the end of our presentation, so it's time to conclude on the retirement bond and its benefits. So what are the main takeaways? First, hopefully it should be clear by now, that the retirement bond is a true risk-free asset in decumulation strategies covering the first 20 years of retirement. The second takeaway is that investors seeking retirement income security should use the retirement bond as a standalone investment to receive constant or, say, cost of living adjusted cash flows. The third takeaway is that investors aspiring to retirement income growth should use a retirement bond as a safe building block of their multi-asset decumulation strategy to efficiently spend their risk budget. And that's, ultimately to either increase their upside potential without taking any extra retirement income risk, or to reduce such risk without giving away any upside. It's also important to note that all these benefits do persist in other interest rate environments, and the results of our robustness tests are available upon request. So what this means, to conclude, is that the retirement bond enhances decumulation investing strategies in any market condition. And one last thing before we open for Q&A. Since its foundation in 2001, EDHEC-Risk Institute has always aspired to produce and promote research that is relevant for the industry. So we're naturally right now advocating the introduction of the retirement bond as an investable solution, and we plan to keep you updated on this matter in 2022. Thank you, and we'll open for Q&A.
Just thank you, Shaya, for this conclusion. Just a comment there. Actually, we have been receiving, and that's really nice, we've been receiving lots and lots of questions. So just want to inform everyone that we will respond personally to all questions in the coming days, above and beyond the few questions that we will have time to address just right now. Let me perhaps start with one first question. Would you argue that a retirement bond could be viewed as a competitor to annuities? Okay, it's an interesting question. So I think the answer is essentially no, for different reasons. No, first, because a retirement bond does not provide any hedge against individual longevity risk. And actually, you could pretty much and very well think about using deferred annuities as a complement to retirement bonds, and these deferred annuities could help you secure income in later life stages, starting, let's say, at age 85, when the cash flows of the retirement bond just do no longer take place. So the retirement bond should not be regarded as a competitor to annuities. It could actually be used by annuity providers and insurance companies for, hedging their balance sheets and performing their asset liability management. I think it would be more suitable to see them as competitors to the fixed income component that you typically find in target date funds and in balance funds. And as was explained in many different places in this presentation, these typical fixed income components have a big problem, which is they do not pay fixed income when investors and when retirees need those fixed income cash flows. So that's more a substitute to fixed income as opposed to a competitor or substitute to annuities. We should perhaps take a second question. Shaya?
Yes, so I see another question, and as you said, we won't have the time to answer all of them on the line, but we will be responding personally to those questions after the webinar. One question that may be of interest to a wider audience. So I read it out loud. It says, if I expect interest rates to rise by the next few years, wouldn't I be better off holding short-term bonds as opposed to long-term bonds like the retirement bond? So the way to approach this is, well, first, as a sort of strategic bet or strategic positioning, I hope that we have convinced you that targeting a duration that's shorter than that of the liabilities, meaning shorter than the payments that are needed in retirement, is a mistake. That is, we do need to manage that risk. So that's from a strategic positioning. Now, as a tactical bet, and that would be a different answer, but we should keep in mind that such an active bet, effectively, is better placed into the risky portfolio or the performance-seeking portfolio, not so much in the safe bucket. The safe bucket being meant for risk management. And maybe one other point to mention there is that, so as I said, we have run robustness checks in other hypothetical interest rate scenarios, given the history for the past few decades has been generally a downward trend in interest rates. So we've looked at stationary and increasing interest rate scenarios, and the results do persist. So we still see the difference in probability of running out of money, and we see the improvement in the efficient frontiers, even in a rising rate scenario. So the intuition there is that just having an increase in interest rates doesn't mean that you're better off with a short-term bond versus a long-term bond. You actually do need to have an increase that exceeds market expectations and whatever risk premium is priced already in the yield curve. So just a simple increase in rate is not going to be enough. And maybe one last question, given we're running out of time here. So I see one question in relation to the affordable income level. So I'm reading out loud. How does one determine their affordable income level using the retirement bond? Okay, so that was somewhat explained in an earlier slide, but let me give you a numerical example. So let's imagine you target a $1 per year income. So your retirement bond has 20 cash flows. Each cash flow is $1. And let's assume that the price of that asset is obviously less than $20 because interest rates are not at zero. And right now, in the current rate environment, it's around 16.5, 16. Let's assume it's 16.6 because that's the number we had in the slide that was towards the end of October. So if you just do 1 over that price, so 1 over 1 divided by 16 and change dollars, you get roughly 6%. And that is your affordable income as a percentage of your wealth. So 6% of, say, $100,000 of wealth, that would be $6,000 per annum. And the other side of the equation, if you like, if you say I want to secure $10,000 per annum as a replacement income, you just multiply that $10,000 by the price of the retirement bond, $16 again, and that gives you $160,000 needed in order to secure $10,000 for 20 years in the current rate environment. I think we're now running out of time. So the other questions that we have received, as I said, we'll be responding personally. I'd like to thank you again all for joining. And that will conclude today's webcast. Thank you very much.
Thank you. Thank you very much.